Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the founding partners of the Dividend Kings, the subscription service on the marketplace on Seeking Alpha. In this particular video, I'm going to talk about something that's very near and dear to my heart. I am known, and I've had several longtime readers dub me as Mr. Valuation. Those of you who have watched any of my previous videos or have long read my articles know that I'm always talking about valuation. And in that regard, as you can see here on the screen, I've written 3 articles on Microsoft prior to this one. In September of 2010, I talked about after a lost decade is Microsoft to buy. Microsoft was trading at PE ratios of around 10 back then, and people just absolutely chastised me because, as I'll show you here in a moment, performance for the last decade had been horrible. They hated Steve Ballmer. It was a dog. It was out of touch. It was a dinosaur. And I got really criticized, and it was, and that valuation, most importantly, was in the eyes of the beholder. Then in November of 2012, a couple of years later, I wrote a second article pointing out that Microsoft has been a better business than it has a stock, but that's about to change. And this had to do with the cloud coming on and so on and so forth. This is about the time I invested in Microsoft, by the way. And then several years later, in July of 2018, I wrote my third article titled Long-Term Microsoft Shareholders, Your Money May Be in Jeopardy, where now I was pointing out that Microsoft was overvalued. I was talking about being undervalued in the first 2 articles and severely chastised and criticized for how foolish I was to recommend Microsoft. And then when I was talking about, the dangers that Microsoft's current valuation held, I was once again chastised for how could I dare criticize such a great company. So what I thought I would do with this video is I'm going to go in and I'm going to actually take a look at Microsoft, and I'm going to run it through several valuation methodologies here, because I think it's very, very important that investors understand that valuation is a risk measurement, number one, and number two, it is a tremendous indicator of long-term performance, but not short-term performance. Valuation is not great for short-term market timing, but it sure is great for protecting your money over the long run or helping you make money over the long run. So let's start out by looking at just Microsoft, the business, and I'm going back to calendar year 2000 here. And what I want you to see is that this, first of all, this orange line is a PE ratio of 15, which is a fair value. I use the word reference, or it's a sensible, prudent valuation for a company that grows at approximately 10% a year, 9.89 over this time frame. I also want you to notice that Microsoft started paying a dividend in June of 2003, but they've had a really excellent dividend record ever since, and a really good payout ratio. Their payout ratio, is averaged in the 40% range. So, it's not really paying out a large portion of its revenue. I also want to point out, because this will become important later, the stock currently is available at a current dividend yield of 1.39%, but most importantly, the blended current PE ratio is 27.58. That is, as I'll illustrate in a moment, an extremely high valuation. But as I pointed out in the written portion of this offering, I really love this company. I've loved this company for a long time. I made a fortune in it, owning it from the early 90s through 2000, and then I bought it again in 2011, I guess it was, and I made a great deal of money on the stock again, but I do consider it currently overvalued, and I'll talk about that. But how could you not like this company? It's, it's $1 trillion market cap, AAA rated, 41% debt, and it has, as a tech stock, considering, how volatile technology can be, it's really put together a great operating record in terms of operating earnings. Now, I do want to look at a couple other metrics before I bring in the nasty thing called price. Let's also I want you to look at operating cash flows here, because operating cash flows have also been very, very consistent. They've grown at about 10.6%. I consider this a second very important valuation metric, which I'll illustrate here in a moment, but I also like to use operating cash flows to see how well the dividend's covered. I want you to notice payout ratio of cash flows are significantly lower than what we saw with operating earnings. Of course, cash flows tend to be a higher per share number than operating earnings. And then I want to take a look at the all-important free cash flow, because if you're really looking at covering a dividend, I want you to see that free cash flows are also critical, and Microsoft covers their dividend with free cash flow like a blanket. So, you really couldn't ask for more in terms of the cash flow front. And then next I'm going to go to EBITDA, which I consider a soft form of cash flow, but it's a very important metric because EBITDA kind of gives you a look at its earnings before interest, taxes, depreciation, and amortization. But again, it's a form of cash flow, and it's also a great valuation reference. And as I'll illustrate here a little bit later, this is probably the one valuation methodology that I'm going to be covering that would indicate that Microsoft might not be quite as overvalued as I'm going to lead you to believe prior to getting here, but it still looks overvalued based on price to EBITDA. So let's go back to adjusted operating earnings here, and let's look at Microsoft from a standpoint of valuation. And let me do that by bringing in monthly closing stock prices. And as I said in the title, there are numerous lessons in valuation here. Now, I recently purchased Microsoft in October of 2011 at a price of we'll call it $27. And then I sold it because I thought it had become too overvalued to hold in January of 2017 at a price of $65. Now, I talked about this in the article. I averaged over 20% a year for investors that I managed money for holding the stock here, but I also left all this money on the table. Now, that doesn't bother me at all because I made 20% a year, and I'm never going to apologize or regret that. And I did buy other investments that have also done quite well. But the point is, I also wrote the article, the third article that I talked about on Microsoft in July of 2018. And once again, I've left money on the table. The stock has gone up, 24%, I guess, since I wrote that article. It's actually probably closer to 30%. I didn't hit my dot here. But the point is, these valuation levels, are continuing to rise. But the point is, since June of last year has still been the short run. To me, the long run is at least a business cycle, which is a minimum of 3 years, usually 5 years or longer. And the reason for that has to do with the numbers. And I just want to show you that because forgetting about price here for a moment, if you look at Microsoft's earnings in calendar year 2000, they earned 85 cents a share. Okay, but they grew that, they more than doubled that by 2008, 8 years later, to $1.87. And then they grew it again by 2018. Earnings were $3.88. Now, there was some little bit of cyclicality in the middle, but here's the point. And I want to talk about this really importantly. The current PE ratio is 27.58. So I'm going to go here and I'm going to try to find a PE ratio as close as I can. There's 28.27. That's maybe, one PE ratio point ahead. And this is a time when Microsoft was really doing very well as a business, and they just started paying a dividend in 2003. But if you'd have bought and held this stock all the way through December of 2012, your total annualized rate of return, annualized now, would have been less than 2% a year. You'd have had only 4% growth, and you would have received a little bit of dividend income, but your total gross rate of return was under 23% for holding it here for almost a decade. But what's really important about this, if I use my scrolling bar here, and these are going to be close approximations, and I bring this scrolling bar back over, to where I'm measuring this time frame here, and I look at Microsoft, the business, forget about the fact that the price was $25 a share and barely higher than that almost a decade later. The point I want you to get is Microsoft grew earnings at over 9% during this time frame. And if I shorten that even a couple of years back further, Microsoft was growing at almost 11% a year. So the point is, Microsoft, the business, was doing extremely well back then. The problem was the stock was significantly overvalued, very similar to the valuation today. Now, this means it had a very, very low earnings yield. Even if I measure it here where the PE was 26 in 2002, even coming out of the Great Recession, you'd have averaged about 2.5%. The point is, but here's the point I really want to make with this particular iteration. This is a very, very long time of really dead money. In fact, you could measure this, it might even be better for my points that I'm trying to make, to measure it from here to here, and you're only looking at a 3 or 4 year period of virtually dead money during a time when the company was doing pretty well. And they had started a dividend, and they had increased that dividend at a very, very high rate. If you look at what the dividend growth was back then, it was extraordinary. They've averaged over 20%, 22% dividend growth since they've been paying a dividend historically. But once again, we have a time here where you didn't make any money due to valuation. I'm going to call this my minimum long term, over 3 years. but it was only valuation that caused you a problem. And then if I take this to where it finally reverted to the mean coming into the recession, now we're looking at 4 or 5 years. I still didn't make any money. And then, of course, the recession came and the stock price dropped. But then let's talk about the other times that I wrote about the stock. I originally wrote about the stock in September of 2010. So let's try to find, September of 2010 here. And I'm going to find it, roughly as close as I can. That's maybe within a couple weeks. I want you to notice nothing happened after I wrote that article to this stock. Really, we got some nice dividend income, but it was actually relatively flat. The rate of return was pretty good, but keep in mind the PE ratio when I bought the stock here was 10, and the PE ratio was only 9 when I'm measuring it again here on November of 2011. So these were very, very low valuation. But then the next time I wrote the article where I said it was a better business than a stock, but that's about to change, was in November of 2012. Now, in November of 2012, which is right here, my timing was really excellent. Luck, pure luck. I wasn't that good. I'm not that good, and I'm not trying to say I'm that good. But what I had ascertained is that this stock had stayed very, very undervalued for a relatively long period of time here. The operating results were good. There were a lot of things happening in the company that were pretty exciting. And then Microsoft started to advance. And the advance since I wrote that last article has been really over 28.5%. But I do want to be clear. I consider this to be excessively overvalued. I would have been expecting my rate of return to be something in the 17% range. In other words, the stock should be trading at a 15 PE. Because if I look at valuation here, you can clearly see that the stock has gotten a very high valuation. Now, if I shorten the time frame, you can see that it's really disconnected from this fair value PE. If I look at forecasting, expectations, and there are quite a few analysts, I might add, that follow Microsoft, are expecting 12% growth over the next couple of years. That is awesome for a company of this magnitude. However, that does not justify a 27.58 PE ratio. The earnings yield on this stock is about 3.5% now, which means if you invested in Microsoft today and the company paid you all their earnings, your return on your invested capital would be 3.5%, and yet you're taking all the risk of buying this stock at such a high valuation. The other thing I want to point out before I get into some of these other metrics, let's look at dividend yield. This is another great way to measure valuation. And this is kind of your mirror image, if you will. During times when the dividend yield, you could get a current yield of 2.7, 2.66, and at its peak here, 2.8% dividend yields, were during the times when Microsoft was trading at a very low valuation as they were growing their dividend. Now we've got this very high valuation, and the current yield is only 1.39%, which is simply another indicator that this is a very high valuation for this great company. Love the stock, hate the valuation. So let's look at some other metrics now. Let's look at it from a standpoint of operating cash flow, which I always like to value dividend growth stocks, especially based on operating cash flow. And here, once again, we see that Microsoft traded, if I put the normal price to cash flow here, it was about 16 times cash flow historically. This was the irrational exuberant period when the PEs got completely ridiculous. This was beyond obvious, overvaluation back here. You're looking at priced operating cash flow of 53. And then you had priced operating cash flow at around 15 and a normal valuation of 16, but that's because you're including these high valuations here. But you can see I bought Microsoft at a significant discount to its priced operating cash. I only paid 8 times cash flow to buy it. I ended up selling it at 14 times cash flow. Admittedly, I sold it early, but as I already covered, I made a great deal of money. But now I see it trading at an operating cash flow of just under 20, which to me is, again, another indication that the stock is overvalued. And as such, probably, the headwinds are against you for making good long-term returns on the stock. Now, I don't usually use free cash flow as a valuation reference, but, it is one that's worth looking at. But here you see a really extended valuation based on free cash flow. I might, consider Microsoft fairly valued at 18 or 19 times free cash flow, which is all the money that's left over after running the business. But up here at 27 times cash flow, 26.78, clearly this stock is overvalued based on a historical norm or even a normal valuation. So there could be, significantly poor performance out over the next couple of years if I measure this based on operating cash flow. It's a great company. No one's denying that. It's just not really attractively valued now. Now, finally, I'm going to go to EBITDA, earnings before interest, taxes, and depreciation. As I stated earlier, this probably gives us maybe the most comfort if you were investing in Microsoft now, because we have had this huge surge in EBITDA, and I've never denied that Microsoft is not doing fabulously. My point is, though, we're not buying it here at a really an attractive valuation. EBITDA growth is expected to be at 13% going forward, so if I measure it at a 15 price to EBITDA, maybe I can make 7% a year. If I price it at its more normal 14.5 times EBITDA, I make 5.7% a year over the next 2 or 3 years, assuming these forecasts turn out to be correct. That's just an awful lot of risk that I want to take for a low-yielding, high-quality company, perhaps the highest quality you could even imagine. Again, everything about Microsoft I love. The only thing I don't like is the current valuation. And then finally, I want to take a look at one other one which is Warren Buffett's favorite, called owner's earnings. And this kind of gives another interesting perspective, because owner's earnings did quite well during this period where I was actually selling the stock. By the way, I didn't have owner's earnings on these graphs then. I don't know if it would have changed my mind or not, keeping in mind that if I'd have been looking at it when I sold it, I would have seen a different picture. I'd have seen this picture here rather than the one that I currently see now. But owner's earnings did drop quite a bit in fiscal 2019, which ended in June, and they're expected to be negative again next year. So, we don't get any forecasts on that, unfortunately, but this would be another indication that Microsoft is overvalued. Now, what does all this mean to me? What this means is that if I held Microsoft, the company clearly has momentum. I'm not going to argue that at all. That's, how could you argue that? You can see that the stock has great investor sentiment. The company's doing a lot of wonderful things. So if you'd have bought it somewhere or was lucky enough to buy it when it was really cheap like I did, perhaps you don't have to be as foolish as I and sell it yet, but I do think you should pay attention and recognize the fact that the stock is not cheap. Most importantly, I do not believe this is a great time to be buying Microsoft. I might continue to hold it had I bought it, a long time ago where I had a good valuation metric. That makes some sense to me, because clearly sentiment and momentum is currently on your side. But, I do want to remind you, I've talked about other companies in the past, companies like Albemarle in lithium that got real hot over a short period of time, and then we had a massive correction, almost a 50% cut. We saw the same thing with General Dynamics, etc. So the point is, in the long run, the headwinds, in my view, are against Microsoft. I think the stock is terrific. I think the business is terrific. I think the long-term opportunities are great for the business, but I don't believe that shareholders are going to make a great deal of money owning this stock from here. And I really wanted to try to also point out that these are mathematical realities here about valuation. These are not just in eyes of the beholder. These numbers, these are all discounted cash flow metrics that basically tell you, whether it's cash flow or earnings or EBITDA or even revenues, that this company is growing quite nicely. But at what price are you willing to pay to buy that growth? Anyway, I really appreciate you going through this. This has been Chuck Carnival. I hope I gave you some additional insights into valuation. Thanks for watching, and look forward to talking to you guys again soon.